Thanks for clicking. All eyes were on the Bank of Canada this morning as the bank was widely expected to raise interest rates by 50 basis points, which would have been the most severe rise in interest rates in 20 years.
Holy sh**.
Then news came this morning that the Bank of Canada was indeed raising interest rates by 50 basis points, putting its policy rate at 1%. The rise in interest rates will obviously have a big impact on Canada's mortgage market as well as Canada's real estate market, as higher mortgage rates will push qualification standards up and push down affordability. So what I want to do today is go over the Bank of Canada's rate announcement, go over some specific examples as to how these higher interest rates will affect affordability, and then take a look at what to look for next. We are set to receive Canada's March inflation rate next week, with the US inflation rate just coming in at 8.5%, and Canada usually following closely behind the US. This will obviously have a big impact on the pace and severity of future rate hikes on the part of the Bank of Canada. We'll obviously have updates on those rate hikes and on that inflation rate coming out next week. Click like and subscribe if you want to get those updates, but for now, let's get into this rate announcement. As mentioned, the Bank of Canada raised interest rates by 50 basis points this morning, bringing the policy rate up to 1%, 75 basis points higher than its low of 0.25% just a few months ago. In anticipation of the Bank of Canada raising its interest rate, mortgage rates have been going up as well, raising over a half percentage point in the past few weeks alone, and over a full percent over and above a few months ago.
Gee, that sounds like a lot.
It's a lot. We've discussed on this channel before how there's been a switch. With rising interest rates, buyers are no longer having to qualify at 5.25%, but rather are qualifying at the contract rate plus 2 points. With the lowest insured rate right now being 3.74, no longer are buyers qualifying at 5.25, they're now having to qualify at 5.74, which can have a big impact on mortgage affordability, on housing affordability.
Rumpus time is over.
With higher interest rates comes less affordability, which will have a big impact on Canada's real estate market. If no one can afford your house, then the price of your house has to come down. For a brief example, let's look at my hometown of London, Ontario, which last month had an average house price of $807,540. When the qualifying rate was 5.25%, buyers had to earn $168,000 with zero debt on a 25-year amortization. Now, with the best fixed interest rate being 3.74, buyers are having to qualify at 5.74, which really reduces affordability. While that $168,000 a month or so ago was able to get you $807,000, now that amount is $770,000. So with that new qualification standards, that $168,000 buys you $37,000 less house than it did a month and a half ago. And this drop in affordability is a problem that's going to happen all the way down the line, not only in London, but in Toronto, in Vancouver, in Calgary, etc., etc. With the exception of cash buyers,
money bags,
Canadians aren't going to be able to afford the homes that they were able to 2 months ago. In February, when we continued to see prices go up even further than our already historic highs. So I would expect to see more and more houses coming on the market in the next few months as potential home sellers try to beat the market, try to get their homes for sale, hoping to get ahead of the reversals that very well might be coming down the pipe anytime soon, if they haven't already. With more and more houses coming on the market, we're likely to see some price cooling.
Finally.
Whether or not we'll see some major house price reversals in Canada's real estate market over the next few months remains to be seen. We have talked about on this channel about some reports saying that we'll start to see reversals as that policy rate goes over 1.75%. And as of the new rate today, we're halfway there. Whether or not we get to 1.75% policy rate, 0.75% higher than it is now, will be largely dependent on the rate of our inflation. As mentioned, the US is at 8.5% inflation, and I would imagine the Bank of Canada is going to be ultra focused on making sure we don't get to 8.5% if we're not already fastly approaching it, but we will find that out next week. We'll have updates on this channel on that inflation rate. Click like and subscribe if you want to get those updates, and thanks so much for watching.